So since long-term is part of our core definition of Section 1231 property, that short-term business assets become ordinary income property, that number 1 category. And the way that this is often stated is the gain is ordinary. Because it's a business use asset, it's still reported on the same form as other Section 1231 assets. However, the gain becomes ordinary, and we'll talk more about what that means. So this is a summary table of our 3 categories of assets, which is based on how they're used. Number 1, ordinary income asset, which includes inventory, accounts receivable. Number 2, capital assets, which is any asset used for personal or investment, and then some specifics. And Section 1231 trade or business property is any asset used in a business for more than a year, depreciable or not depreciable. And remember, they're specifically not anything in any other category, and any short-term trade or business assets are actually treated over here as ordinary income assets. So is land a capital asset? Think about that for a second. You've just learned the 3 types of assets. Is land a capital asset? It depends on use, right? All of our categories do. So if it's used as investment, if someone just buys the land and they're holding on to it to sell it, that's a capital asset. If it's used for business, so they're actually like operating their business on it, then it's Section 1231 property. If it's used to resell, they're a property developer, this is what they're in the business of doing, then it's actually inventory and it's ordinary income property. So land's a good example of how it could literally be all 3 based on use. So now we'll get into the taxes under each of these categories. We've covered the use. You determine where the asset falls, 1, 2, or 3. Now we'll look at how they're taxed once you determine that they fall into that category. So gains on the sale of ordinary assets, they do not receive any preferential tax treatment. That just means they're taxed at the ordinary rates. Now, losses on sales of ordinary assets are fully deductible. So while the gains are taxed at ordinary rates, losses are deductible. So, ordinary tax rates, ordinary income property, ordinary tax rates. Whatever the tax rate would be based on the type of entity, individual, or business, and the tax bracket that applies because of their income level. So, ordinary income property, gains taxed at ordinary rates, losses are deductible, but it's really the basis of that inventory, accounts receivable, or note receivable is being deducted or written off. So for example, inventory is deducted in cost of goods sold. So capital assets. There's a difference between how we're going to tax personal and investment use. Although they both fall under this category, there's a difference in how they are taxed. Now, if you have more than one asset, there is a netting process which can make your gains and losses more advantageous than it might look when I go through this right now. But if you had one asset, or once you complete the netting process, short-term gains and losses essentially have no advantage, but long-term do. The gains are taxed at lower rates, and losses can be deducted from ordinary income up to $3,000 a year from other income like working income, whatever income you have. Now, unused losses are carried forward to future years, so you don't lose those losses. Now, when it comes to personal use, gains are taxed at ordinary marginal rates, just like our number 1 category, and losses are not deductible. So it's we really encourage investment, and we don't encourage personal use. So capital assets taxed at preferential rates. This is a tax benefit. They're essentially going to pay a lower rate than they would pay on a gain than if this capital asset didn't exist and capital gain rates didn't exist. So basically we have marginal rates, so it's based on your tax bracket of 0%, 15%, 20%. Then, like I said, the subcategories do get into types of assets. And so there's some subcategories which have a limit on taxes of 25% and 28% when they would otherwise be taxed at ordinary tax rates. So this is a summary of these beneficial capital asset tax rates for 2017. They changed the brackets, and they didn't apply the brackets as they had always applied them in the past. And what that did is it actually created a situation where a single person making a little bit above this is going to pay a higher rate because everything I just covered about taxability was kind of a simplification and an overview of the rates. To determine taxability, we're going to have to look at the holding period, whether it's short-term or long-term, the asset sale, whether it's a gain or a loss, the type of capital asset that was sold, the taxpayer's tax bracket, the netting process. So if there's only one asset, it doesn't matter. But if you have more than one asset, which is most common, then there's a netting process to combine gains and losses. Qualified small business stock, QSB, has special rules. We won't really be getting into those in this video. I'd do a separate video on those. So additional holding period rules for a capital asset. Short term is less than 1 year, long term is more than 1 year. But if it's received as a gift in a non-taxable exchange, then the basis is the same as the transferor. In an inheritance, basis is always long term, regardless of how long the person who owned the asset actually owned it for. So someone could purchase an asset before they die on behalf of someone, and then when they pass away, that becomes a long-term capital gain asset with these preferential rates to that descendant. So let's look at an example. An asset is purchased on June 20th, 2016. When does the holding period start? Remember the rule? Starts on June 21, 2016. Now, the asset is sold on June 20th, 2017. Is this gain or loss going to be short term or long term? What do you think? June 21, 2016 through June 20th, 2017. Has it been a year? Short term. It's short term, even though it's 1 day. But if the asset had been sold on the 21st of 2017, then it would have been long term. So just by 1 day, it can make a difference between these lower rates or higher rate of their ordinary rate. So this netting process, you calculate all long-term and short-term gains and losses. And from there, you net all the short-term gains and losses to obtain a net short-term gain. And you do the same thing with long-term. So you end up with a net short-term gain, net long-term gain. Before that net, you would have a total short-term gains, total short-term losses, and then those become net gain or net loss short-term. And same for long-term. So remember to separate gains that are taxed at 28% and 25% rates out of the grouping, because they're going to be treated separately on the forms because of those tax rates. Now, this explains what happens in each of the scenarios. So if you have a net short-term gain and a net long-term gain, then the short-term gain is taxed at regular rates and the long-term gain is taxed at the preferential rates. If you have a net short-term gain and a net long-term loss, you can offset them, and then the net result, if it's long-term, then if it's a loss, then it can be deducted $3,000 per year. If it's a gain, it's taxed at regular rates, because the net short-term was a gain and the net long-term was a loss. So they're just maintaining their character for whichever is greater once they net. Net short-term loss and net long-term gain. Separate long-term gains into their groupings. Any net short-term loss first offsets the higher gains and then the lower rate gains as they go. So this is most preferential. Net short-term loss and net long-term loss. So only $3,000 of loss is deductible per year. Short-term losses are deducted first against other income, and if any maximum remains, then they deduct the long-term losses up to $3,000 max. Excess losses are carried forward and they stay as short-term or long-term when they carry forward. Now, all of this is represented on the forms and essentially calculated on the forms. So let's do an example. Situation 1, we have a long-term gain of $8,000 and a long-term loss of $3,000. We also have a short-term gain of $5,000 and a short-term loss of $4,000. What are we going to do? We need to combine the long-term and combine the short-term, right? Which is going to give us a net amount. So this is our first netting. So we end up with a long-term of $5,000, $8,000 minus $3,000, and then $5,000 minus $4,000, so a short term of $1,000, and they're both gains. So in a gain-gain situation, net long-term gains are taxed at the preferential rates, net short-term gains are taxed at ordinary rates, because there's no other way to combine them at that point. Another example situation is long-term gain of $3,000, a long-term loss of $8,000, a short-term gain of $4,000, and a short-term loss of $5,000. So in our first net here, we're going to end up with a long-term loss of $5,000 and a net short-term loss of $1,000. So this is that loss situation. So the results of this are that you get to use the short-term loss first. Carrying over a net long-term loss is going to be more advantageous because it will net with short-term gains, whereas a short-term loss is less advantageous, basically. So the net short-term loss is used first. This $1,000 goes towards our $3,000 that we can deduct, and then we take $2,000 out of the long term. So we'll deduct $3,000 made up of 1,000 short-term loss, 2,000 long-term loss, and we carried forward 3,000 net long-term loss. In this example, we have some other parts in the mix here. We have a 28% gain of 4,000, a 25% gain of 2,000. Now, of course, a lot goes into figuring this out, but they're just giving it to us for this netting process. Long-term gain of 10,000, short-term loss of 10,000. So what is our first net result in? Net long-term gain of 10,000, net short-term loss of 10,000. There's nothing to net them with, right? And the results would be that 4,000, this is the highest tax to us. So we want to get rid of this first with our short-term loss, right? This long-term gain, this is taxed at preferential rates. This is the highest gain we have. We can't net these three gains, but in using this loss, we can get rid of the bigger gains first. So once we wipe out our 28% gain, we have 6,000 left over. That 6,000 then covers the 2,000 here. So we have 4,000 left over, extra zero there. We can't move on from capital assets without mentioning the additional investment tax. This tax is what the Affordable Care Act added to cover health care for everyone. And it was a 3.8% Medicare surtax, and it only applies though on certain net investment income, on individuals who have modified adjusted gross income above threshold amounts. So you have to be earning a lot of income that you're not working for in order for this to apply. So net investment income includes interest, dividends, rental, royalty income. It also includes, but not limited to, stocks, bonds, mutual funds, real estate, passive investments. So this tax only applies on monies that you don't work for, and once you are earning a significant amount of money. So the 3.8% surtax is imposed on the lesser of net investment income for the year, the total amount of all those incomes, or modified adjusted gross income over a certain amount. Now, the reason this tax was added is because so many people with investment income, so many of the very wealthy, create all sorts of loss scenarios where they spend money and it offsets their taxes. So most people in very high income tax brackets that are making a ton of investment money, they don't pay taxes like people earning under $100,000. They pay far less. They'll pay effectively 5 or 6%. And I'm not talking just because this is something that's well known in the tax professional industry and among politicians. I'm saying this because I saw this in preparing high net worth individual returns through the big four public accounting firms. So I've witnessed this firsthand. They can be paying $500,000 in tax, but when you divide that $500,000 by the total income they earned, they're paying 6% taxes. And let's be honest, that's a lot of money. It takes a ton of ordinary people earning under $100,000 to make up that difference in tax. So that's where this came from. Excuse my rant, but a lot of people don't really understand these things. So you only start paying this tax if your modified adjusted gross income, which means after some deductions and various considerations, is $250,000 for a married filing joint, filer, filing status, or qualified widower. $200,000 if you're single or head of household, and $125,000 if you're married filing separate. Remember, the tax rules are always disadvantage to MFS, married filing separate. It's not really meant to be an option. It's a last resort. So let's do an example of NII so you can see how this actually works. A couple has $290,000 of modified AGI and $86,000 of investment income. So do they owe the NII tax? Yeah, they're over $250,000. So the amount is going to be calculated on this because it's less than this, right? 86,000 times 3.8% is $3,268. And so you can really see that the bulk of money is not coming from people at this stage. It's coming from people who are earning substantially more investment income. Now to the third type of property and how it's actually taxed, the Section 1231 sale of business property. So there are three aspects that are going to contribute to how it's taxed. Whether the asset sold at a gain or a loss, whether the asset had been depreciated, which is very common for business property, and then whether the asset was real property like buildings or personal use property like equipment and